Inflation is a sneaky thing. It slowly eats away at the value of your hard-earned money. Imagine a basket of everyday goods. Inflation means the price of that basket goes up over time. What you could buy for $100 last year might cost you $105 this year. That's inflation at work. This constant rise in prices has a ripple effect. It impacts everything from groceries and gas to housing and healthcare. For people on fixed incomes like retirees, inflation can be especially difficult. Their income stays the same, but their expenses keep increasing. Inflation is a natural part of any growing economy. However, when prices rise too quickly, it becomes a problem. Central banks closely monitor inflation rates. They try to keep inflation at a healthy level, usually around 2 to 3% per year. Inflation is a silent threat to your savings. When prices rise, the purchasing power of your money decreases. Imagine you have $1,000 in a savings account earning a measly 1% interest. If inflation is running at 3%, your money is actually losing value over time. This erosion of purchasing power also affects investments. If your investments aren't growing at a rate higher than inflation, you're losing ground. This is why investors seek out assets that can outpace inflation and preserve their wealth. Protecting your savings from inflation is crucial for long-term financial well-being. Ignoring inflation can lead to a decline in your standard of living over time. It's essential to find ways to make your money work harder and outpace the rising cost of goods and services. Investors look for ways to protect their money from inflation. They turn to assets that tend to hold their value, or even increase in value, during periods of rising prices. These assets are called inflation hedges. Think of an inflation hedge as a shield against the eroding effects of inflation. Some common inflation hedges include real estate, commodities, and precious metals. These assets often perform well when inflation is high. The key is to diversify your investments. Don't put all your eggs in one basket. By including inflation hedges in your portfolio, you can potentially offset losses in other areas during periods of rising prices. This helps protect your overall wealth and maintain your purchasing power. Gold has long been considered the go-to inflation hedge. It's a tangible asset with intrinsic value, meaning it has worth in and of itself. However, silver also deserves a place in the conversation about inflation protection. Silver shares many similarities with gold. It's a precious metal with a limited supply. This scarcity makes it valuable. Silver also has industrial uses, which provides additional demand and price support. However, silver is generally more volatile than gold. Its price can fluctuate more dramatically in the short term. This volatility can be a double-edged sword. It presents both risks and potential rewards for investors. Understanding the differences between gold and silver is crucial for making informed investment decisions. Silver has a long and storied history as a form of currency and a store of value. For centuries, civilizations around the world have used silver coins for trade. This demonstrates its enduring value. Throughout history, silver has maintained its purchasing power during periods of economic turmoil. For example, during the Roman Empire, silver coins retained their value even as the empire experienced high inflation. This historical resilience makes silver an attractive option for investors seeking a safe haven during uncertain times. While past performance is not necessarily indicative of future results, silver's track record as an inflation hedge is noteworthy. It suggests that silver may continue to offer a degree of protection against rising prices in the future. This historical context can provide investors with a sense of confidence when considering silver as part of their portfolio. The price of silver, like any commodity, is determined by supply and demand. This fundamental economic principle dictates that when supply exceeds demand, prices tend to fall, and when demand outstrips supply, prices rise. However, the silver market is particularly nuanced, influenced by a myriad of factors that can shift this balance in unexpected ways. Several factors influence the delicate balance between these two forces. These include not only the obvious elements like mining production and industrial demand, but also more subtle influences such as investor sentiment, geopolitical stability, and technological advancements. Each of these factors can have a significant impact on the market, making it essential for investors to stay informed and adaptable. Understanding these factors is crucial for investors looking to navigate the silver market. By keeping a close eye on market trends and being aware of the broader economic context, investors can make more informed decisions. This knowledge can help them anticipate market movements and potentially capitalize on opportunities that arise from shifts in supply and demand. On the supply side, mining production plays a significant role. The amount of silver extracted from the earth directly affects the available supply in the market. Factors such as the discovery of new silver deposits, the efficiency of mining operations, and the cost of extraction all contribute to the overall supply. Discoveries of new silver deposits or advancements in mining technology can increase supply and potentially lower prices. For instance, if a new rich vein of silver is found, it can lead to a surge in production. Similarly, innovations in mining technology can make extraction more efficient and cost-effective, further boosting supply. Conversely, disruptions to mining operations such as labor strikes or geopolitical events can constrict supply and push prices higher. Political instability in key mining regions or environmental regulations can also impact production levels, leading to reduced supply and increased market volatility. On the demand side, industrial applications account for a substantial portion of silver consumption. Silver's unique properties, such as its high electrical conductivity and antimicrobial qualities, make it indispensable in various industries. Silver is used in a wide range of industries, including electronics, solar panels, and medical devices. In electronics, it is used in circuit boards and connectors. In the renewable energy sector, silver is a key component in solar panels. In healthcare, it is used in medical devices and antimicrobial coatings. As these industries grow, so too does the demand for silver, potentially driving up its price. The expansion of technology and renewable energy sectors in particular has led to a steady increase in silver consumption, highlighting the metal's critical role in modern industry. Investment demand also plays a role. Investors often turn to silver as a hedge against economic uncertainty and inflation. The metal's historical role as a store of value makes it an attractive option during times of financial instability. When investors perceive silver as a safe haven asset, they tend to buy more, increasing demand and potentially boosting prices. This behavior is often influenced by broader economic conditions, such as interest rates, currency fluctuations, and global economic trends. Understanding these dynamics can help investors make more strategic decisions in the silver market. Investing in silver, like any investment, comes with its own set of advantages and disadvantages. Silver has been a popular choice for centuries, often seen as a safe haven in times of economic uncertainty. But as with any investment, it's important to understand both the potential rewards and the risks involved. It's essential to carefully weigh these factors before making any investment decisions. Consulting with a financial advisor can provide valuable insights tailored to your personal financial situation and goals. One of the main advantages of silver is its potential to act as an inflation hedge. When inflation rises, the value of currency can decrease, but silver often retains its value, making it a reliable store of wealth. As we've discussed, silver has historically held its value during periods of rising prices. This historical performance can provide some peace of mind to investors who are concerned about the eroding effects of inflation on their savings. This makes it an attractive option for investors looking to preserve their purchasing power. In addition to its role as an inflation hedge, silver is also used in various industrial applications which can drive demand and potentially increase its value. Additionally, silver is a tangible asset. Unlike digital investments or paper assets, you can physically hold silver in your hand, which can be reassuring for those who prefer to have a physical representation of their wealth. Unlike stocks or bonds, you can hold silver in your hand. This tangibility can provide a sense of security for some investors, knowing that they have a physical asset that isn't subject to the same risks as digital or paper investments. This tangibility can provide a sense of security for some investors. Storing silver in a safe or a secure location can give a sense of control and peace of mind, especially in times of financial instability. However, silver is not without its drawbacks. One of the primary concerns is its price volatility. The value of silver can fluctuate significantly over short periods, which can be stressful for investors who are not prepared for such swings. As mentioned earlier, it can be a volatile investment. Market conditions, geopolitical events, and changes in industrial demand can all impact silver prices, leading to potential losses if the market moves against you. Its price can fluctuate significantly in the short term, which can be unnerving for some investors. This volatility means that silver may not be suitable for those with a low risk tolerance or those who need quick access to their funds. Moreover, silver does not generate income like stocks that pay dividends or bonds that pay interest. This means that the only way to profit from silver is through price appreciation, which can be unpredictable. Its returns are solely based on price appreciation. Investors must rely on the hope that silver prices will rise over time, which is not guaranteed and can be influenced by a variety of factors beyond their control. It's crucial to carefully consider these advantages and disadvantages before investing in silver. By understanding both the potential benefits and the risks, you can make a more informed decision that aligns with your financial goals and risk tolerance. For those considering adding silver to their investment portfolio, here are a few practical tips to keep in mind. Investing in silver can be a rewarding venture, but it requires a strategic approach and a good understanding of the market dynamics. Let's delve into some essential guidelines that can help you navigate the complexities of silver investment. First and foremost, do your research. Before investing in any asset, it's crucial to thoroughly research and understand the risks involved. This means not only looking at the current market trends but also understanding the historical performance of silver. Read financial reports, stay updated with commodity market news, and take detailed notes. Knowledge is power, and the more informed you are, the better decisions you can make. This is especially true for commodities like silver, which can be volatile. The price of silver can fluctuate due to various factors such as changes in industrial demand, geopolitical events, and economic conditions. By understanding these factors, you can better anticipate market movements and make more informed investment choices. Second, start small. If you're new to silver investing, it's best to start with a small allocation and gradually increase your exposure over time. This approach allows you to get a feel for the market without risking too much capital. Small investments can help you learn the ropes and build confidence as you gain more experience. This allows you to get a feel for the market without risking too much capital. Additionally, by starting small, you can test different strategies and see what works best for you. It's a learning process, and taking it step by step can help you avoid costly mistakes. Third, diversify. Don't put all your eggs in one basket. Diversification is a key principle in investing that helps spread your risk. By investing in a mix of asset classes, including stocks, bonds, and commodities, you can protect your portfolio from significant losses if one asset class underperforms. Diversify your portfolio by investing in a mix of asset classes, including stocks, bonds, and commodities. This strategy not only helps in risk management but also provides opportunities for growth across different sectors. A well-diversified portfolio can weather market volatility better and offer more stable returns over time. This helps spread your risk and potentially enhance your returns. Diversification is not just about spreading your investments across different asset classes, but also within the same class. For example, within commodities, you can invest in silver, gold, and other precious metals to further mitigate risk. Finally, consider your time horizon. Silver is a long-term investment. Its price can fluctuate in the short term, but over the long haul, it has the potential to preserve and even grow your wealth. Understanding your investment timeline is crucial because it influences your strategy and risk tolerance. Its price can fluctuate in the short term, but over the long haul, it has the potential to preserve and even grow your wealth. Historical data shows that silver has been a reliable store of value, especially during times of economic uncertainty. By holding on to your investment for the long term, you can ride out short-term volatility and benefit from potential price appreciation. Investing in silver can be a smart way to hedge against inflation and potentially enhance your portfolio returns. Silver often performs well during inflationary periods, making it a valuable addition to your investment strategy. By including silver in your portfolio, you can protect your purchasing power and achieve more balanced returns. However, it's essential to approach it with caution, do your research, and make informed decisions. Investing in silver, like any other investment, comes with its own set of risks and rewards. By staying informed, starting small, diversifying, and considering your time horizon, you can make more strategic and confident investment choices. Remember, the key to successful investing is not just about making money, but also about preserving your wealth and achieving your financial goals.